This video is based on Canadian tax policies in effect as of the date of recording. Content is for informational purposes only and is not intended to replace independent advice. Hello, YouTube world and all its inhabitants. It's Monique Madden again, certified financial planner, financial management advisor, and certified financial divorce specialist. Today I'm coming to you to discuss RSPs, when to use them, why to use them, and a couple of strategies on how to optimize your RSP dealings. Of course, you want to be very mindful of the fact that in this particular year, the deadline to be able to apply your RSP contribution against last year's income is March the 1st. So you want to make sure if you do intend to claim it for last year that you make your contribution by March the 1st. So my objectives for our time today are fourfold. I want to give you a quick refresher on why we use RSPs and what they can do for us as Canadian taxpayers. I want to give you an idea of how to decide between using the RRSP versus other savings vehicles, other types of accounts. I want to talk to you about how to optimize your RSP contribution. There's no question that putting the money into the RSP typically will do you well, but there are optimization strategies that I do want to share with you. And then lastly, I want to answer the age-old question, which is if I have some discretionary income to apply to a goal, would we be better off repaying our mortgage or contributing to the RSP? And of course, that's something that's often top of mind with heavy debt loads as Canadians are facing these days. So just some background information. I'll go through this quickly because RSPs are thankfully more commonly understood than they once were. A registered retirement savings plan, really all it is a tax-advantaged account. It has nothing to do with the way it's invested. It has everything to do with the way the bank registers the account. And just as an insight, if you ever want to know what the Canada Revenue Agency is trying to implement by way of social and behavioral change, just look at where they offer tax incentives. So really, all the RSP does is it achieves the government's goal, which is to provide a tax incentive to encourage Canadians to take personal control over their retirement rather than trying to live off of the Canada Pension Plan and old age security alone. CPP and old age security will not be enough for the vast majority of Canadians. I am not suggesting that they won't be there for us. There certainly are stabilization measures that were put in place when I first started in the financial industry to make sure that they they have longevity and that they will be available for future generations, but simply the payout is not enough to maintain someone in, never mind a large urban center. Most Canadians couldn't live on what CPP and OAS pay. So we have to be incentivized to take control of our own retirements because those two income sources probably will not be enough. The way the RSP achieves that tax incentive is that every dollar that's contributed is then excluded from the calculation of your taxable income. So when we report our taxes, you'll know that there is a whole calculation to get down to what your taxable income is, and then your tax rates are applied to it. The RSP removes income from that calculation of the taxable income. And most importantly, the way the incentive works is it gives you a tax refund today. Now, I do put the today in brackets or with an asterisk here because I will be encouraging you to take a little bit more deliberate control over how you claim the deduction, and we'll go through that in a few minutes. So, as Mr. Chaucer so famously said, all good things do ultimately have to come to an end, and that's where the Registered Retirement Income Fund, or RRIF, comes in. So, a RRIF is really the sister of an RSP, whereas the RSP, the S stands for savings, the RRIF, the I stands for income. So, when you convert your RSP to a RRIF, and usually this is done by age 71, December of the year in which you turn age 71, then your contributions or savings end, and you begin to be compelled to withdraw from the account in dribs and drabs over many years. The RIF requires mandatory annual withdrawals the year after it's established, so there is 1 year grace period. And those withdrawals are based on your age and the value of the account the previous December 31st. So every year, once the RIF is converted, every year your financial institution will report to you what the next year's minimum RIF payment must be, and that's the amount that you need to withdraw from the account and claim for tax purposes. So that's how you can see that the RSP achieves that tax incentive in that it gives you an immediate tax refund, hopefully, or at least maybe reduces the amount of taxes owing if you have otherwise untaxable income or untaxed income. And then, in theory, it taxes you later on in small increments. Those increments, start off in the 4 and 5% range and then increase to 20% per year once you get into your 90s, so that ultimately the RSP or RIF, to be more correct, is exhausted by late in your retirement. So there's really two ways to withdraw from these accounts. You can, in theory, withdraw from an RSP, although I wouldn't recommend it unless it's a last resort, because of course you pay taxes on any withdrawals. And you can also withdraw from your RIF. So the key difference is that if you withdraw from an RSP, so before it's been converted to a RIF, it will be subject 100% of what you withdraw will be subject to withholding taxes. The withholding taxes range between 10% for withdrawals that are under $5,000 to 30% for withdrawals exceeding $15,000. So there's a couple of things there. The truth is that the withholding tax of 10% doesn't sound like much. But it does if you're withdrawing during your working years and you're withdrawing because you need the money. If you need $5,000 and you withdraw $5,000 from an RSP, you're only going to net $4,500 after the withholding tax is considered. So then you start into a slippery slope of having to withdraw in excess of what you need to get the amount that you need because of these withholding taxes. So that's a bit of a pain. The other unfortunate thing is, of course, the withholding taxes themselves, if you're withdrawing from an RSP while you're working, may not be enough to cover the actual taxes payable. RSP withdrawals, RIF withdrawals, they're all taxable at your marginal tax rate. So that is, and I hate to use jargon, so I'm sorry, but this one term is pretty important. Marginal tax rate is the highest tax rate that you yourself are subject to. And I'll show you an example in a minute. Anyway, back to RSP withdrawals. A withholding tax of even 30%, if you're withdrawing from your RSP and you're a high income earner, that 30% might not be enough. So at the end of your reporting period, the following April when you're claiming your taxes, you might still owe taxes for the money that you withdrew what could be 16 months earlier. So it really is a very slippery slope. In contrast, RIF withdrawals, if you are withdrawing only what is mandated, again, that amount that your bank or insurance company has told you you must withdraw for that year, the annual minimum RIF, there is no withholding tax. You will pay tax at your marginal tax rate in the end, but at least a $5,000 withdrawal will see a $5,000 deposit in your account. Only withdrawals from a RIF that exceed your annual minimum RIF payment are subject to those withholding taxes. So that's also a pretty keen change. So, by way of strategy, if you need money from your RSP and you're still in your you're sort of in your peak earning years or nearing retirement, and you foresee a time where you're going to need consistent income to supplement perhaps semi-retirement years or things like that, you might be well served by converting your RSP to a RIF early, just in order to trigger the annual minimum RIF payment that would then not be subject to the withholding taxes. Again, the only difference being that the amount that you want to withdraw would be the same amount that would be deposited in your account, rather than there being that 10, 20, or even 30% withholding being held by the bank or trust company or insurance company. So let's just go quickly over the marginal tax rates in Canada. These are indicative of Ontario, and Ontario is not the most highly taxed province. I believe Quebec is, but this is an example. So this would certainly serve for anyone across Canada, but to differing numbers. Essentially, the more you earn in Canada, the more you pay in taxes. It's a graduated tax system. So within each of these tax brackets, you're taxed at a certain rate. The first 42,000 or so is taxed at 20%. The next 42,000 is actually split up into smaller tax brackets, but ranging, let's say, between 24 and 31.5%. Then there's a really big tax bracket of, what is that, about $66,000, varying from 34% to 46%. And then we're getting into very, very steep taxation in excess of $150,000 in taxable income. So what ends up happening with the RSP then is it certainly can give you a front end benefit through the deduction that you can claim in the current year, but it could potentially create or intensify tax problems in retirement when you have to report that income on top of other sources of retirement income. So really, for an RSP to work, it requires a certain measure of tax conversion. What does that mean? Well, this particular table shows the taxes as a percentage of annual income for a particular individual. The taxes paid is in the y-axis here, and the age of the individual is in the x-axis here. So this particular person is sort of in his or her nearing peak retirement age, peak earning age rather. And so let's say at 51, this person's at about a 26% tax burden. This person's anticipating a little bit of an increase next year, meaning that he or she might be subject to 28, 27%, and then some fairly consistent high taxation very near the 30% mark until he or she retires at age 65. And in this particular case, we're assuming that this person defers withdrawing from the RSP or RIF until that latest opportunity, which you see here is age 72. At age 72, we start having to draw from the RSP or RIF, and you see consistent higher taxation than before, but certainly lower than during this person's working years. And that's all we're trying to depict here. Don't worry about the details. But what we're saying here is that this particular person is subject to higher taxation during his or her working years than he or she will face in retirement. This is the perfect example of how an RSP is helpful. You want a deduction in these years when your taxes are heaviest, and you want to claim the withdrawals during years when your tax burden is lower. But that's not the case for everybody. Let's take this person, for example, 10 years later. 10 years later, this person's now 61, still earning, but making, let's say, consistent RSP contributions. So rather than a 30% tax bracket, this person's now, what is that, maybe a 28% tax bracket. And in this particular case, I'm assuming that he or she starts withdrawing from the RIF at age 69. Well, looky here. All of a sudden, with diligent savings, you have taxes being lowered during your working years only to be even higher in retirement than they were during the working years. Well, how does this happen? This happens through diligent savings, perhaps the sale of a property. Now, even your principal residence, if you're selling it, is a non-taxable asset, agreed. You will not be taxed on the appreciation on your home, but when you go and reinvest the proceeds, they will turn into taxable interest, dividends, and capital gains from the investments from that point onward. So this is really not an uncommon situation for those who are planning on selling a property at or near retirement. For clients here who see an increase in their tax burden when they're going to be withdrawing from their RSP or RIF, for those clients, they might even be better suited to a tax-free savings account contribution rather than an RSP. Admittedly, the TFSA contribution will not give you a tax benefit in these working years. I understand that. But what it will do is it will control your taxation during your retirement. And that can be pretty important to a lot of people, especially those who really want to preserve their entitlement to the old age security benefit, which is income tested. So if you're earning too much in retirement, you will see a reduction in your old age security or even an elimination of your old age security benefit. Rest assured, Canada Pension Plan is not clawed back in the same way, but old age security is, and OAS is in the high $500 a month range, and I certainly wouldn't tear up a check for $6,000 or $7,000 a year, that's for sure. So as Whitney Houston famously sang, how will you know whether you should be contributing to the RSP or the TFSA? Well, I'm going to use an example of that old age security clawback threshold, which is $75,910 in taxable income for 2018. So if you're projecting that you're going to be eligible, let's say, for the maximum Canada Pension Plan entitlement, which in this current year is $13,610, you can earn or collect up to $62,300 in taxable income before your OAS is even threatened. Well, that sounds like a lot of money, especially per person. So if you're coupled, this is per person. But at a 4% return, that really requires about $1.58 million in capital. Sounds like a lot of money to me, that's for sure. But let's again remember that if you're selling a home, especially in a large urban area in Canada, and saving diligently, it certainly is not beyond the realm of possibility that you could accumulate $1.58 million in capital for investment. And a 4% return it's not easy, but it's certainly possible. You could certainly find yourself in a situation where you're being clawed back and subject to relatively high taxation. And I call relatively high taxation in and around 30%. I think if you essentially don't earn a penny until May of every year, that's pretty significant. So let's talk then about a few strategies to optimize the RSP contribution. So I want to talk about who should make it. If you're coupled, which spouse should be making that contribution. Let's talk about how you would make that contribution. discretionary income is more and more scarce these days. And then when should you make the contribution and when should you claim the deduction? And those two things can be very different, as I'm going to show you. So first of all, who should make the contribution? If you're coupled, it's important, although fewer and fewer couples are thinking this way, it's really important that you think of finances as a household. And although people do still like to keep money separate, when it comes to strategy, you really should be looking not only at your own tax situation, but your spouse's. So when it comes to RSP contributions, those contributions should be made and claimed by the higher income earner. And here's why. The same $1,000 contribution made by someone who earns $50,000 a year is going to earn them a refund just shy of $300. That same $1,000 contribution made by someone earning $150,000 a year is going to earn nearly $465 in refund. That's for every $1,000 of contribution, you would see a discrepancy of nearly $170. That is tremendous, and especially when you're looking at multiples of that $1,000 contribution. So it's really important that the contribution be made and claimed by the higher income earner. Now, some people do confuse this with the spousal RSP, which is a system whereby the higher income earner again makes and claims the contribution into an account that becomes the property of the lower income earner in order that the withdrawals ultimately would be in the hands of that lower income earner in retirement. Now, it is still, I guess, a valid strategy, although we'll talk in a minute that very liberal retirement income splitting opportunities have made the need for spousal RSPs quite a bit dampened from what they once were. They're not quite as necessary at this point. Nonetheless, we're still just talking about the contribution and claiming of the deduction really should be in the hands of the higher income earner. Well, we're all in best intentioned. We want to make RSP contributions, but again, if you're raising a family or you're living in a large urban area, where's that money going to come from? Well, I would argue that the money is there. And the money is there because if you file what is called a T1213, an example of which I've shown you here, this form tells your payroll department of certain tax advantaged situations that you're subject to. So of course this only applies to those who are employed, not the self-employed. But if you are employed and you're subject to either a commitment to an RSP contribution, which of course I would encourage, or you have childcare expenses, or you're paying spousal support, or a number of other measures that you would get a tax advantage for when you file your taxes, what this T1213 does is it informs your payroll, and your payroll can make adjustments before they even pay you the money. So what do I mean by that? Let's take, for example, someone who earns $75,000 a year, and they have made a commitment to contribute $1,000 a month to their RSP. Now, before I go any further, let me just underscore the fact that it is no small feat to do that. I'm not saying this tritely. $1,000 a month is an awful lot of money. And it would be hard for this person to find, I would imagine, especially if they have large financial commitments. But filing the T1213 after you've made that commitment to the $1,000 a month automatic savings plan means that rather than payroll remitting taxes for someone who earns $75,000 a year, payroll will instead remit taxes for someone who earns $63,000 a year. Well, what does that do? It drops your payroll deductions right away. It increases your take-home pay, with which you have more money to make the RSP contribution or the spousal support payment or whatever it is. And there's a list here. It may be hard to see right now, but if you were to pull this up online, you would see a few of the tax measures that would give you the opportunity to enjoy this. One word of caution is if you're going to file the T1213 and make these changes to your source deductions, follow through. Because if you don't follow through, you're going to get a nasty surprise the following April or May when you file your taxes and you realize that not enough was remitted at source and you have to write a check to the tax department. Another optimizing strategy is the idea of contributing now and claiming later. So again, I'm using here an example of someone who earns $80,000 a year. A $10,000 contribution, again, that's a mighty lot of money. But a $10,000 contribution for someone who earns $80,000, if the full contribution is deducted in that year, only a portion of it is going to be subject to this highest tax rate, this person's marginal tax rate, you'll recall. It's basically, what is that, $5,687, I guess it is. The difference between $80,000 and $74,313 would be subject to a 31.5% rebate. That's amazing. The other $4,313 would be refundable at 29.65%. I certainly wouldn't tear up a check for that, but there is a way to optimize. You would optimize by making that same $10,000 contribution, but only claiming as much as you need to get rid of the income in this, subject to this taxation rate, which would be the amount in excess of $74,313. So this person, if they wanted to optimize the strategy, would claim $5,787 in the current year, and then carry forward the balance, the $4,313, to the following year. And barring any changes to their income level, they should be at roughly the same tax bracket the following year, in which case both portions, the amount claimed in this year and the amount claimed next year, would both be subject to 31.5% rebate. So, not to say that claiming the full amount in this year is not a good thing. It would be great. But if you're asking me how to optimize, you would optimize by dividing the tax deduction between this year and next. Right? For this client, I would still argue that the RSP is the better solution. So the exception to the decision between the RSP and the TFSA based on the absence or existence of tax conversion is whether or not this person has a much lower income spouse with whom they can then income split at retirement. So lastly, the question being, should I make a contribution to my RSP or should I pay down my mortgage? Well, don't get me wrong, they're both great strategies. But again, as a fee-for-service financial planner, people are asking me about how to optimize. So let's look at it detail by detail. So what does someone stand to gain by each strategy? Well, an RSP contribution gives you a tax refund in the quote-unquote current year, and you know why I'm being coy about that now, and saves for retirement. Whereas paying down your mortgage will make you mortgage-free sooner and save you interest. Well, at what rate would I save that interest? Well, let's say many mortgages now are, let's say, in the 3% range. But that 3% is not a good comparison here because, of course, RSP contributions give you a tax advantage. So let's convert that 3% to, let's say, a pre-tax amount would be, let's say, another third or so. So even call it 4%. At what rate would I be refunded for an RSP contribution? Well, we talked about this before. The first tax bracket is 20% in Ontario. The federal tax bracket is certainly in excess of 14 or 15%. So even if you're looking at relatively low levels of taxation, that first tax bracket, you'd be looking at least a refund of 14 or 15% plus your respective provincial rate. So is there any comparison between a 4% benefit and a 15, 20, 25% benefit once you consider both federal and provincial taxes? I don't think so. The RSP wins out for the vast majority of Canadians. And I can tell you, by the way, I can tell you this in a way that investment advisors cannot, because I don't stand to benefit from it. I don't sell anything. I'm just telling you the strategy from the tax perspective. Now, as is always the case, there's always an exception for every rule. And that is to say that if it should be that making your mortgage payment will allow you to be mortgage free by retirement, I say taxes be damned. Do it. Because I cannot impress upon you how difficult it is to cover mortgage payments on a reduced income at retirement. So yes, there would be a tax advantage to making the RSP contribution for the vast majority of Canadians, but if that mortgage payment would mean that you would be mortgage free by retirement, I would prefer you make the mortgage payment, especially in those earlier mortgage years when you are when it would be most impactful because each mortgage payment is so heavily concentrated with interest. So, as always, if there are questions, if I can be of any help, please reach out. Here are all my coordinates, my phone number, my email address, my website, my YouTube channel, my Twitter handle. Please engage. As you know, I don't sell anything but my time and expertise, so you needn't worry about products of any sort, only strategies. I'm also giving you a few nuggets here that are important. The Canada Revenue Agency's My Account website is one that would give you all sorts of details with regards to your personal RSP contribution room, your TFSA contribution room, which would be different for everybody listening to this seminar, and all sorts of other valuable information. And as I remember talking about earlier in this seminar, your marginal tax rate is pretty important, as is your spouse's marginal tax rate. So I've given you a website here, taxtips.ca. It has all sorts of great information and calculators to help you, plan on when to claim things, looking at the suitability of different strategies, because it'll give you information on what this year and next year's tax brackets are. Very, very helpful stuff. So as always, thank you for your time and attention, and we'll speak again soon.